Let's look at the definitions prescribed in Chapter 5 of the 2019 FSI's Guide for the elements of the sectoral income and expense statements, or, in IFRS terms, the Statement of Profit and Loss. We will use the deposit taker sector as our example. Note that many of the definitions are also applicable to the other financial corporations, or OFC, subsectors. Interest income and interest expense is a form of income and expense that accrues on debt instruments such as deposits, loans, debt securities, and accounts receivable or payable. The income and expense statement for deposit takers has 13 lines. Interest income, line 1, includes fees and commissions that are an integral part of the effective yield of a financial instrument. An example would be an origination fee or commission paid by a borrower to obtain a loan. The amount of the fee or commission should be recognized over the life of the loan as interest income. The 2019 FSI's Guide recommends that provisions for accrued interest on non-performing assets be deducted from gross interest income to compute interest income. Recall that this treatment differs from IFRS 9. This treatment better reflects the interest actually earned during the accounting period. Net interest income is defined as interest income, line 1, less interest expense, line 2. Non-interest income, line 4, includes all other income earned by deposit takers. Compilers will map the typically much more detailed financial statement data obtained from supervisory sources to the 4 subsets of non-interest income prescribed by the 2019 FSI's Guide. Gross income, line 5, is the sum of net interest income, line 3, and non-interest income, line 4. Non-interest expenses, line 6, are subdivided into 2 categories which capture all non-interest expenses except provisions, or, in IFRS terms, allowances for loss. These categories are personnel costs and other expenses. Personnel costs include the total remuneration in cash or in kind payable by the enterprise in return for work done by employees during the accounting period. Personnel costs are typically one of the largest expense categories and are used in the calculation of earnings and profitability FSIs. All other non-personnel related expenses, including extraordinary expenses, are recorded in other expenses. Provisions, line 7, are subdivided into loan loss provisions and other financial asset provisions. Loan loss provisions are net new allowances for losses that deposit takers make in the reporting period. The amount will reflect one of 2 circumstances. One is a net increase in expected credit loss, or ECL, which is an expense. The other is a net decrease in ECL, which is income. Other financial asset provisions include the expense incurred to establish an allowance for ECL for any financial assets, other than loans, which are within the scope of IFRS 9. Net income before tax, line 8, is gross income less non-interest expense and net provisions expense. Income tax, line 9, includes those taxes that accrue in the accounting period which are related to income, profits, and capital gains. Other taxes, such as sales taxes and value-added tax, are recorded in other expenses. Payroll taxes, such as social benefits contributions, are recorded as personnel expenses. Net income after tax comprises net income before tax, line 8, less income tax, line 9. Other comprehensive income or loss, net of tax, line 11, records the total from the Statement of Other Comprehensive Income and Loss in an International Accounting Standard, or IAS 1, compliant set of financial statements. Dividends payable, line 12, are dividends declared but not paid in the reporting period. These amounts will be distributed in future to the owners of the enterprise. Retained earnings, line 13, will be posted to the retained earnings account in capital and reserves. Retained earnings comprise net income after tax, line 10, less dividends payable, line 12.